stereotypes, breaking the rules. You can't tell me what is for me. Yeah. You got a lot more behind those pretty eyes, but you gotta let the world see. Yeah. So shake it up. Now is the time while you're waiting. You're good enough. Now is the time while you're waiting. What are you waiting on? Don't let them bring you down. They ain't rocking with you, so what? Yeah, you're gonna be cool without them. Don't let them bring you down. They ain't rocking with you, so what? Yeah, you're gonna be cool without them. Oh, don't let them bring you down. And don't let them bring you down. Oh.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and we have a lot of good information to cover today. But before we begin into that, what I want to do is I want to share with you a short little parable. I heard this story today, and it was so inspiring, and I thought that it relates to a lot of what a lot of you go through when you're dealing with stocks, with you're dealing with how you're dealing with your money. And you may have heard this story before. It's called the river story. And the way that I portray this with retirement and investing is in this way. There was a husband and a wife, and they were on the side of a river. And they were enjoying a lunch, just sitting there. The water was pretty rapid, but they were just sitting there enjoying the day. And all of a sudden, they heard a child screaming. There was a child that was drowning and that was just floating down the river. The husband kicks off his shoes and he dives in the water and goes to get the child, brings it back over. It's not breathing. They resuscitate it, the husband and wife. And then all of a sudden, the child is just breathing again. And so it's just amazing, but they're still wondering, where did this child come from? And suddenly they're just sitting there and they're wondering, they're talking with each other and they're trying to comfort the child, and they hear it again. They hear another child coming down the river, just screaming and asking for help. They're drowning. The husband's spent. He's tired. He says, I don't know if I can do it again. The wife says, it's okay. I'll take care of it. She kicks off her shoes. She jumps in the water. She pulls the child back over to the shore. It's like the other one. It's not breathing. They resuscitate it. They bring it back to life. And all of a sudden, they notice there's another child coming down the river. And they're yelling and screaming. They've already got two over here that are crying because they're just displaced. They just or almost drowned. So the husband dives in, gets the child, brings it back over to the shore, and they have three children now that are just crying. And then they hear another one. This goes on for probably about a good half an hour. And finally, at about a half an hour, there may be 6 or 8 children on the shore, and they're just crying and just bawling, and just the husband and wife don't know what to do. And all of a sudden, the husband gets up and he starts to walk away. And the wife says, where are you going? And the husband says, I'm going upstream to see who's throwing these babies into the river. Ladies and gentlemen, the idea of life is preparing for what's happening in the moment, preparing for it. Don't wait for it to happen and then all of a sudden react. Go to the head of the stream and find out what the problem is. Now, when I talk to people about how they're using stocks and how they're using it for retirement, you can't treat it like that your hair's on fire. You have to treat it like it's a plan. If you're treating your investments like you're a speculator, I would like to ask you to reconsider. Investing, there's not a lot of successful speculators out there. There are some, but there are a lot of you out there that are treating this like that you're going to get rich and you're going to retire based on the fact that you're trading stocks. You need to treat this as being an investor. And if you use it in that particular fashion, then it will reward you. You need to go upstream with your strategy. You need to look at your investments. If you're looking at it for retirement, one of the things that I tell people is that we help them to retire without running out of money. And that's what we're trying to do. But we have to go upstream and we have to look at some of these different things. Look at this just for a moment. These are downstream problems. Work. How long am I going to work? Where am I going to live when I'm retired? What am I going to do if my health fails? What about my family? What if my spouse gets sick? What if my children get sick? What am I going to do for long-term care? Am I going to be bored during retirement? What am I going to do when I'm retired and I don't have anything else to do? And how am I going to justify my life's purpose? If you wait and you react on these things when they happen, you're not going to have a result. You have to have a plan and you have to go forward. You have to treat it like the example that I just gave you, where the child's coming down the stream. Make sure you know where that child's coming from. Go up there and find out who's throwing it in the water. Prepare for the future. That's the whole idea. And if you treat investments like that, then you're going to be much more successful going forward. Get a plan and put it in place. I have a plan that I use in my practice. My practice is called Richard's Financial Planning. I have a plan that I've developed that's called the Secure Future Plan. And the Secure Future Plan has 3 simple steps. It's really simple. You and I meet virtually and we discuss what your vision is for your future. Then I put together a plan, which is the step 2. And then I work with you in step 3 and implement a plan and monitor it all along the way. It's really pretty simple from that standpoint. Don't wait until the problem arises before we react. Okay, with that in mind, I have some great stocks to talk to you about today. So let's get started into the NASDAQ stock update. Okay, the 2 stocks that we're going to be covering today are CoStar Group and CSX. CoStar Group, you might not be familiar with, but they're a real estate data company, and CSX is a railroad. You might have thought that the NASDAQ 100, which is really what we cover every day here, that the NASDAQ 100 is just tech stocks. And yes, I guess you could classify CoStar Group as a tech stock because they deal with big data. But CSX is very far from being a tech company. It's a railroad. It's a very important component of our country. And both of these stocks have some exciting stories to talk about. So let's talk about them in more specificity. Geez, if I can get that word out. Okay. Let's look at how things ended up with the market today. The market was up about 0.58. Some resources tell you that it's up about 0.6%. The entire market was up. Gosh, if you looked at what the data was for the past month, 3 months, the year, you would have never thought that there was a coronavirus pandemic crash that happened in between February and March, because most stocks are back. Not all of them, but most of them are back to where they were. CSX ended the day at 76.99. It's up 1.4% for the day. If we look at CoStar Group ended up also 0.8%. Now, let's broaden this out just a little bit and look at these stocks over the past year. If you follow the dancing cursor, you can see this is what happened in between February and March. And it seems like such a long time ago. But then again, to some people, it seems like it's lasted so long, and I completely understand. But as we go further over to the right on the graph, when we look at the spaghetti graph, we see where we are right now. And from the standpoint of the market in itself, what we're going to do is we're going to talk about these stocks in comparison to the NASDAQ, since they are NASDAQ stocks. But we're also going to compare it to a benchmark that's called the Standard & Poor's 500. Now, a lot of you are familiar with that. And you understand that it's the largest 500 companies in the United States. when we look at it from that standpoint, we understand that it has ups and downs from that standpoint, and the volatility, that is the up and down gains and losses of that particular index, we use a statistic to rate that. That's called beta. And the Standard & Poor's 500 has a beta of 1. And when we compare the other stocks, we're going to talk about those today as to how they compare, so you can see if they're more aggressive than the S&P 500, or perhaps they're the same as the S&P 500, or as some stocks, perhaps they're less volatile than the S&P 500. Now, if you look at the big jump that's over here with CSX, we're going to talk, actually, that's not CSX, that's CoStar Group. There's a big jump that occurred there around in July, and we're going to talk about why that happened. CoStar Group, if you're not familiar with it, this is their story. They're a leading provider of commercial real estate and data throughout the United States, and it is a truly unique company. When we look at the valuations on what some of the experts are saying about CoStar Group, right now the close today was $853.04 per share. The value that Morningstar is saying is the fair value of that stock is $612, which would give it perhaps a 2-star. Now, a lot of stocks, when you look at them and there's maybe a $200 disparity in between what the fair market value is and what the actual closing value is, it might be considered more of a 1-star. But you're going to see there's a reason why there's more optimism with CoStar Group than there is with some other stocks that might have closer valuations in there. Now, I like to also, in the last couple of days, I've had people that have asked me about what other analysts are saying about these stocks. So what I did is I went out and I looked at the general average analyst, and what we're seeing with the CoStar Group is that most analysts are putting this down as a buy. Some of them are saying it's a moderate buy, and only 1 out of 9 of them said that it was going to be a hold, and there are none that are saying that it should be a sell. Now, I do want to remind you that I'm reporting to you this information as education. This is not a recommendation for you to go out and buy or sell this stock. Use this to make better educated decisions. Just like when I told you a few minutes ago about the idea of not making decisions like the child in the river. Make sure you understand the source. Go upstream. Use this information to strategize for the long term. Don't use this information to try to get rich. It won't work. Now, when we look at the potential profitability of the company, we often look at what's called the moat. And if you've joined me before, you understand what a moat is. This is a moat. Remember, if you have a narrow moat, you don't have a lot of room for sustained profitability. But if you have a wide moat, yes, you have sustained profitability. And that's one of the things that's going for CoStar Group. CoStar Group has an amazing $3.5 billion cash position. The data that they supply, that they sell, is proprietary. In other words, you can't get it from another source. This is the closest things, ladies and gentlemen, to a monopoly that I think you're going to see. There's not another company out there that has this kind of information. There's no competition. That's why Morningstar is rating this as a 2-star, even though it's going to be over top of the value. Now, I want you to remember that too when we start looking at the PE ratio, because it's going to, you'll understand why the PE ratio. That's the second day in a row that I've done that. I'm not going to do that on Monday. Okay, let's look at the spaghetti graph of the CoStar Group. Obviously, you know what happened over here during the time between February and March, but what the heck happened in here where we see such a jump up? You don't see that quite as much. We saw a big drop in one of the stocks that we dealt with. I can't remember the name of the stock right offhand, but we've seen a 35% drop based on bad news, but this was actually good news. CoStar Group, as I mentioned before, closed up 0.8%. And when we compare it to the S&P 500, we go to that statistic that I talked about a minute ago, because some people like to think, how is this in relation to the Standard & Poor's 500? Well, when we look at the beta and compare it to the S&P 500, remember the beta of the S&P 500 is 1. And when we look at the beta of CoStar Group, it's 1.14989, which really means that it's about 14% more volatile than the S&P 500. This is the big surprise. The PE ratio is an astounding 103.5. The average PE ratio for the S&P 500 right now is 30.16. That's a big difference. Now, what does that kind of information mean? It means that this stock is it's pretty high priced over top of what its earnings are. And sometimes that can relate back to a stock, or else some people might think that that points to the fact that this could be a more volatile stock. Not really the case as much in this particular stock, and I prove I bring the example, I prove it by comparing it to the Standard & Poor's 500. It's a little bit more volatile than the Standard & Poor's 500, but not quite as much, even though that we did see a pretty big jump back in July based on their earnings. When we look at actually what happened, this was what happened in July. CoStar had a 16% increase in revenues year over year for 2020 for the second quarter. The June sales reached an all-time high of $22 million. And I mentioned this just a few minutes ago. They have $3.5 billion in cash right now. Now, the company has said that they're going to use that for future acquisitions and perhaps to go into other particular areas. One of the areas that they're investigating and doing research right now is in apartment complexes of an average of about 100 units. So they're expanding outside of their normal data sales operations into other areas, which is kind of good because it does give some diversity to the entire company in itself. But they've got a lot of cash and they're looking to put it to work. Now, one thing I talked to you all about in all of the stocks that we deal with is going to be their dividends. If you're retired, looking for dividends is a good thing, but you won't be able to look here because CoStar Group does not have a dividend. So let's jump right on into CSX. This is a good old-fashioned railroad. This is, the railroads that are going to be in the monopoly game. And CSX is a hallmark of railroads in itself. Now, we get back to the idea of the moat, and you might think that because it's an old mode of transportation that there's a lot of competition out there. Well, let me tell you what, the competition is not keeping up with railroads. CSX has still got a very wide moat, a very wide range for profitability. They're a key to the American freight moving from coast to coast. They're primarily an East Coast railroad, and they have a substantial cost advantage. The cost advantage is that they actually have lower freight cost, lower transportation costs based on fuel, and also they have a much larger capacity for transporting the amount of goods too. So they have a very wide moat for profitability in itself. Now, when we look at the valuations of the stock, Morningstar gives it 3 stars. So a lot of times, if you follow me before, and you're looking at ratings of companies and you think 1 star, 2 star, 3 star, 4 star, 5 star, it's not like a restaurant. You've heard me say that before. It's not like you're getting and expecting good food. The idea is the fair market value. And when we have a 3-star company, a lot of times what we're going to see is that the valuation is going to be very, very close to what the fair market value is, or else the actual closing value of the stock. The closing value today of actually CSX was $76.99. So it's a 3-star. Now, when we look at what analysts are saying right now they're not as bullish on this stock as they were on CoStar Group, but they're still pretty good. If we look at the 19 odd analysts that were polled, we find that 9 of them put out a strong buy on this, 1 had a moderate buy, and then 9 of them had just a hold on the particular stock in itself. And I want to reiterate and remind you, this is not buy-sell recommendations. This is just education, lets you know what other people are thinking about this stock. Okay, let's just move along and look at it in comparison to the S&P 500. You know the story that went on here in February and March. The beginning right after March with this particular stock was that there was a lot of stress that was put on the transportation lines on the supply chain. So we see a lot more volatility in the time period right after the coronavirus market crash back in February and March. But we've seen a pretty good recovery from the standpoint of the value in itself. It's not quite to where it was. The highest point for this stock was on February the 20th. It was at 79.616. And then when we look at it, the close today, it's 76.99. So it's close to what its high was back in February, but we're not quite there yet. When we compare it to the S&P 500, remember we talked about the beta. What we're seeing is a little bit more volatility here than the S&P 500. So that's probably what you could expect for this stock. I'm going to reiterate this about a lot of different things you hear me talk about as far as like projections go, though. The past performance of it is not a guarantee of future results. The PE ratio is really pretty good, even though it's a little bit more volatile than the S&P 500. I think the excess volatility is due to the recovery that occurred, the supply chain problems that occurred right after the market crash. So that up and down added to the average volatility of the stock in itself. But the PE ratio is pretty good. Remember that the PE ratio, or the price to earnings ratio, for the S&P 500 right now is a little bit over 30. This stock's about 10 points less at 20.3. So it's actually pretty good. Now, this is a stock for you all who are retired. If you're looking for stocks that are going to pay you income, this is a stock for you to consider. It has a dividend that's forward of 1.37%. But remember that stock dividends are not guaranteed. You have to understand that there can be some volatility in there from time to time. One of the best strategies that you can utilize if you're looking for utilizing NASDAQ stocks for dividends, you can put together a portfolio that's just the NASDAQ 100 stocks that pay dividends. Now, we do that through a strategy that's called direct indexing. We don't use an ETF. We don't use a mutual fund. We go directly and buy the stocks for clients so you own it directly. And we weed out the stocks that don't pay dividends, and then you can utilize it. Some retired clients will actually take that money as income. Some of it will have it plowed back in. Now, remember, there's primarily 3 reasons for retirees to buy stocks. Number 1 is going to be growth. Yes, growth. If you retire to age of 62, you might live for 30 or 40 years. So you might be thinking that, well, I've got plenty of time for a portion of my assets to be in growth stocks. Then the second reason is going to be for dividends. And then the third reason is going to be there are people out there that just like buying stocks, and that's okay. The intellectual stimulation for understanding what's going on in stocks is a very intriguing aspect of investing, and some people just like it. Okay, so let's get back over to what I was talking about just a moment ago. All right, let's look at the insiders that's going on with the companies that we're talking about today. CSX is kind of an interesting insider situation. When you look at the graph that you see in front of you and the numbers, you don't see that big of a difference in the number of shares that are being sold and bought. In the past 3 months, there's 4 buys and 4 sells. And in the last 6 months, there's 5 buys and 9 sells. But it does not tell you the amount. And I think that's something that we need to pay attention to when we see big trades that are occurring. Look right here. there were 768,421 shares. Remember, this is an expensive stock. Well, not as expensive as Apple or Berkshire Hathaway, but it's still an expensive stock. But the idea is there's a lot of shares that are being traded. So why is that? Let's take a look. In the past, I believe it was actually, it happened in April, but there is an activist shareholder, and his name is Paul Halal. Pardon me if I mispronounced his name, but he's actually, they consider him an activist investor. He runs a hedge fund, and he has a substantial position in CSX. And actually, CSX came to an agreement to buy the shares back from him. So it's not anything out of the ordinary. It's not like that you have an insider who is a CEO or something like that. And we've seen in days past where we've seen a lot of shareholders that are executives with the company that are selling because things are overvalued. That's not the case in this particular situation. Remember, you have a PE ratio that's around a little bit over 20, so it's not substantially overvalued from that standpoint. It's just a regular mode of business, but it's good to know so that you know that the company is what's going on from that standpoint. So let's look at CoStar Group. CoStar Group is an interesting company too. When we look at the number of buys and sells that are going on inside, you don't see a lot that's different. It's pretty narrow. In the past 3 months, there were 5 buys and 5 sells. When we look at the past 6 months, it was maybe a little bit more. And when we even that out over the past 12 months, it was marginally higher, not significantly higher. So I don't really think it's anything out of the ordinary to look at. These are primarily, if you were to look at the actual list, and that's available from the Securities and Exchange Commission, the list of executives or people that are board of directors, et cetera, that are buying and selling, what you're going to see in some of this is that these are people that are exercising options. That's part of their income as an executive, and they're just exercising those for whatever reason. It's not anything substantial to consider. Okay, let's get into the last part of today, which is talking about the ESG. ESG is an exciting thing for a lot of people because there's a lot of you out there that do not want to invest in companies that go against your moral principles. That's perfectly okay. That's what we help you with. That's what I help people with. When you look at the list that's in front of you, what you see, and I talk about this every day, so I'll be real brief if you followed us in days past, you see a listing of the different areas of ESG. Some of it is favorable, some of it's unfavorable. What we want to do is wind it down for these individual companies. And if there's some attributes, some investing attributes that people are not fond of, we want to make you aware of it. So if it's something that you want to pull out of your investing portfolio, then that's something that would be that would help you out. So let's move right into it. This is interesting with CoStar Group. With CoStar Group, we look at the ESG rating from MSCI. MSCI is a part of Morgan Stanley that does ratings, and they have an excellent group that does ratings for ESG. When we look at the rating for CoStar Group, you would think they're a big data company. How could they get a poor rating? Well, what I believe that MSCI is looking at is they are looking at what's happening internally on what type of deals that they're working on. Are they green? Are they dealing with environmental issues? And when we look deeper at what's going on at the company level, what MSCI is telling us is that they are lagging behind in their corporate governance, the way that it's structured. They could do better with their privacy and data security, and also in carbon emissions. So you might think, gosh, they produce data. How can that have anything to do with carbon emissions? Well, it has to do really with the deals that they're working on, the businesses, if they're office buildings, if they're apartment complexes, et cetera, are the carbon emissions that are being that are going through these different entities, how are they being accounted for and how are they being dealt with? So what MSCI is telling us is that the carbon emissions, corporate governance, and privacy and data security could be improved upon. CSX, on the other hand, rates much higher than CoStar Group. Their rate is an A on the scale that you see that's in front of you. Now, there are one or two areas that might not be as good. They have an excellent corporate governance record. Health and safety is a laggard, and it's a business that has a lot of manual labor that's involved with it. You wouldn't see as much of that with a company like CoStar Group, because CoStar is primarily going to deal with office workers. You're not going to have people that are doing manual labor the way that you would with a railroad. So that's part of the difference. But overall, you'll see that CSX has an A rating where you saw CoStar Group had a B rating. Now, not every rating company gives the same opinion. And I think that that's very evident when we look at the biblical responsible investing history. Remember, when we're looking at BRI, we're talking about the biblical aspects of customer service, community, workforce, and how they are as a citizen to the world. When we look at CoStar Group, they actually rate very well. They're a plus 39. Remember, the company that we utilize and we talk about that does the rating is called Inspire. And Inspire rates companies on a scale from plus 100 to minus 100. The minus 100 are going to go against biblical aspects. The pluses are going to be advantageous, or they're going to be favorable towards biblical responsible investing. And they rate it as a plus 39, which is actually pretty good when we're looking at companies and comparing them. And ironically, CSX Group has the same rating, a plus 39. If you want more specific information about any of this, all you need to do is go to my website at richardsfinancialplanning.com and go down to the teal button which says schedule a call to learn more. And then you can sign up and I'll give you a call and we'll talk for about 15 or 20 minutes. You can ask me whatever question that you have and we can discuss any concepts that you want clarity on. And then we can see if there's a basis for doing future business from that standpoint. Now, one of the things that I do want to bring about and mention to you as we end today, remember, to help you to really get to the objectives that you're looking at, I'm encouraging you to go upstream to find the problems. Don't treat investing as you are a speculator. Most people that speculate in stocks don't win. There are some that do, and I know that they're all over YouTube and they're all over Facebook, and not as much on Facebook because Facebook frowns upon that, I believe. But you can find lots of people that are touting the best investment strategies on YouTube all day long. Most of those, I'm not going to talk specific about anybody, but I'm just going to tell you, before you put a lot of money into any of these strategies, deal with a paper account. Paper accounts cost you nothing. If you think, I'd like to get involved in investing stocks, but I don't know what to do. I've got a mutual fund at work. I've got some that I bought on my own, but I don't know what to do. So, but I heard about this guy and he's got a great tip. Well, before you go putting your money into it, use a paper account. There's a company that I recommend to people that's called Webull, Webull. And actually you can put money into it. It's like a Robinhood, it's a discount broker. But the reason I like Webull is because they allow a paper account. And what you do is imaginary. You can put $1 million and pretend that you're trading it in real time, just like you were with real money. Of course, there's nothing to be gained or lost in there. So you can see if it works. You can see how the information that from any of these guys on the internet would work to your advantage. If you're sitting at home and you've got plenty of time and that's what you'd like to try, please try a paper account before you stuff some money into this and might come out with less than what you anticipated. If you need help in direction in putting together big plans of your overall strategy, as I mentioned before, I have a 3-step process. You can find more about it on my page at richardfinancialplanning.com. We've ended a great week, and I think that it's time to go relax for the weekend. So without further ado, I'm going to suggest that you listen to the disclosure that I'm going to have at the very end, and we'll see you on Monday. Thanks for joining me.